But hopefully people are joining and coming through. We're not able to see exact numbers come through, so we're just hoping to see some people filter in. But there was a bit of delay coming onto LinkedIn as well. So anyone who is online, apologies for listening to us ramble and figure that out. But hopefully you guys are able to hear us okay and see us okay. And we'll get things going just given the time. So yeah, Ian, I'm going to hand it over to you to kick things off. That's all right. And we're delighted to have Ian on the webinar with us. And given his career from rugby into startup operator and now angel investor as well, Ian's kind of well placed to ask some questions and give us some background on what he's doing as well. So I'll hand it over to you, Ian.
Yeah, thanks a million, Rob. And yeah, delighted to be on with yourself and Scott. Been fascinated following your guys' journey and all the challenges you've had to get to this point. Obviously, I've finished playing professional rugby a couple of years. My full-time role is with DataShips, where I'm heading up the sales team there. And yeah, I've invested in various startups, and this one certainly piqued my interest, especially around what you guys are doing, but more so the people behind it, in yourself and Scott. So yeah, today I'm going to turn the tables and ask you guys some questions because I'm fascinated to find out more myself. So diving straight in, but we will do some customer questions at the end. But to start off, like, why did you guys build Shuttle?
Yeah, well, I mean, myself and Scott go back, as you know, Ian, a long, long time. And we were investing together with no major degree of sophistication, but investing together nonetheless in cryptocurrency about 10 years ago, about 9 or 10 years ago, amongst some other things. And we found ourselves drawn into it quite a lot, and as many people were, and really, really interested in the space and all the various coins that were launching at the time. And we invested in loads of different stuff within the space, and we did quite well out of it. But we found ourselves, I guess, our financial literacy kind of came on from there a little bit, and we kind of found ourselves looking for other opportunities, other investment opportunities. I had started working at Salesforce. I was paying into the employee stock purchase plan and the pension. I was started using apps like eToro, which was kind of the first investment app that I had come across at the time and started using. And I guess we were just kind of looking for more. We were kind of going, what else is out there? We're investing in crypto. We're investing in public stocks. What else can we look at? And we found ourselves drawn to private market opportunities like venture capital. But quickly realized that that's a world that's just completely reserved for, the high net worths and institutional investors of the world. And there was a number of barriers that kept people like us outside, which is like regulation and high minimums and closed networks and whatnot. So we found ourselves going, well, we want access to these things that potentially are higher yielding, more interesting opportunities to build wealth. But clearly we're not allowed, right? They're gate kept. There has to be more people like us. Myself and Scott were working in tech. Scott was building technology for startups and for the giants of the world, your Googles and Nikes and whatnot. And I was selling into venture-backed tech startups at Salesforce. And we already had a kind of affinity to technology and interesting technology. And we knew there must be more people like us who are also probably working in technology or tech adjacent industries who are already investing like us, who want access to other opportunities as well. We couldn't find the platforms out there that would allow us to access these things. So we ignorantly thought, well, why don't we go and build it?
Yeah, it's fascinating. I think like the big one that stands out for me is the barriers to entry. As like for people like ourselves, I don't have 100K to be investing in venture capitalists, but if there's 100 people who are similar to myself that have 1,000 and we can come together and make that investment and look at those exciting yields and exciting opportunities, that certainly draws me in, and that's why I'm particularly interested in this. I suppose the next question would be why now? Like why do you think this is a good time to do this?
I think there's a couple of like big macro elements to this. I think first, like where we are in terms of like personal finances, it's never been harder to afford a home. Job security has kind of gone through the roof, or insecurity, should I say. Pensions are suffering, as you might know. So people are kind of looking for more ways to build wealth. Like a salary and pension alone is not going to cut it anymore. And investing has just become mainstream within the culture. I mean, looking at the breakout of platforms like Robinhood, Revolut, DeGiro, all these kind of democratized investing in public markets. And then thinking about the second kind of major shift is around private companies in general and how long companies are staying private for and not choosing to IPO. So by the time a company does IPO these days, like if you look at Stripe, they're already at a 90 billion valuation. So when they do IPO, all of the value from their kind of early stages has been completely extracted by institutional investors and ultra high net worths. So kind of the average retail investors aren't getting an opportunity to participate in that growth of these private companies. Even like in the US stock exchanges, back 20 years ago, there was 8,000 public companies. Now there's only 4,000, 4,500. So there's been a 50% drop in public companies. So just people need to have access to the upside, the value that's being generated before a company goes public, because it's taken them so long to go private these days. So I think that's a big part of why now.
Yeah, and I think a lot of people who'll be on this call will have a pension and maybe have dipped their toe into the stock market using platforms like you mentioned, like eToro, where you can dip in, dip out. Look, your pension manager or the company you're working for will largely look after your pension. But focusing on Shuttle, how does it work for the customer?
Yeah, so for any of our customers, they sign up, they pay a subscription fee to access the platform, be a member of Shuttle. It's a €250 annual subscription to join the platform. That's giving you access to the curated deal flow. So we're sourcing deal flow where venture capital funds are leading these fundraising rounds. You're guaranteed to be co-investing alongside at least one venture capital round in every company that you're investing in, if not more. You pay for access to that exclusivity. Ultimately, these are startups that are not going to be fundraising on public platforms where you can go on and see a list of fundraising companies. These are going to be private competitive fundraising rounds. You pay to be a subscribing member. It's almost like a private members club type feel in terms of you cannot get access to the opportunities or see the opportunities unless you are a member of the platform. Every member has their own account that they set up when they onboard, that they top up with their investable funds. So they set up a direct debit, the amount that they wish to invest every quarter. That tops up their investable accounts. They're always ready to go when new opportunities go live on the platform. We do the work. We do the heavy lifting through the network that we've built over the few years it took us to get regulated by the CBI. The network that we've built with venture capital funds, with investors, with founders. We do the work to source opportunities through that network to negotiate allocations in fundraising rounds that we can then expose to our community of users. So we might, for argument's sake, a company might be raising $1 million, 2 million, 5 million, whatever it might be, and we might negotiate a small allocation, a small chunk of that, right? That we can fill through our community. We have an understanding through the data that we have of, number one, how much liquidity is in the platform, what's the likelihood of, what number are we going to be able to fill based on our number of users, the liquidity on the platform, taking into account some a percentage of drop off, etc. And then we expose that to our users. We present that to our users on platform. We present all of the information you would expect to see around the company, the problem they're solving, the solution, their technology, the team, the market that they're going after, the traction that they've achieved so far, et cetera, who's investing, and everything that, gives our customers clarity and conviction on making that decision to commit to these opportunities or not. They will always have that final say. We're not going to invest our money on their behalf. That's their decision. But should they have conviction on that opportunity and want to commit, within a couple of clicks, they can have committed their capital invested in those that company or those companies, I should say, and that all of that information is then stored on platform in their portfolio. The companies that they've gone after, broken down by industry and sector, and the amount that's invested in each opportunity, et cetera, how many shares they own in each of those companies, et cetera.
Yeah, and on that, like when I was following the journey that you guys were on, and the different investments you were making, I was pleasantly surprised at how accessible they were. Even while this is for the everyday punter on the street, I still thought it might be, a minimum of $5,000 or $10,000 over the course of 12 months. Like, what is the initial entry point to come in and make an investment over a 12-month period, for people who are happy to do direct debits?
Yeah. So I would say, just on that, in terms of who we do go after, I would say we are actually going after a specific segment of people. It's probably not for everybody. We are going after the kind of what's considered mass wealthy, if you will, or high earners within the retail investor segment. So we're probably not going after everybody, and we're probably not geared towards everybody. This is an asset class that even sophisticated, educated retail investors wouldn't have had access to before. So even people who have experience investing in ETFs and stocks or managed funds in the public market space, it's for people like that who now want to get some exposure and diversify into something new. So it's probably not for people who have never invested before or don't have any exposure to public stocks or ETFs and things like that. So it probably is for a specific segment within that kind of retail investor space. But in terms of accessibility, it is very accessible. So like minimum top up on a quarterly basis is €250. That's €1,000 a year. So for us, it really is about building and creating that accessibility within a space that's historically been known to be exclusive and limited in who it allows in. So we really do want to encourage more people to look at this asset class and take advantage of it as a potential, small portion of your portfolio. But it's not something where, if you have no experience whatsoever, you should be, looking at, or certainly not where you should be parking all of your capital.
Yeah, I think with that, it's getting an understanding of the venture capitalist markets for, €65 a month to start off. You can build your confidence. Maybe you get a bonus and you go, right, well, I'm going to increase from $250 a quarter to $500 a quarter, and then an exciting opportunity comes up and you may increase to $1,000. And as you get more familiar with how venture capitalists works, how this platform works, I think it's a great journey for people to go down. As regards like the risk involved, people will obviously want to get a better understanding of that. Can they expect to double their money, to triple their money over a period of time? How do you guys look at managing risk?
Yeah, I can jump in here. I think it's a long-term asset class. So you're kind of it's a liquid, so you'll be locked into investments for 5 to 10 years before you do start seeing a return. But I think venture is kind of a game of statistics. Like you can have a strategy in place that makes sure you have limited your downside exposure to risk as much as possible, and that's by having as many shots on target as possible, or having a really broad portfolio. I think if you, in this asset class, if you invest in 5 or 10 companies, you're not diversified enough, and the chances are that you're definitely going to lose money that way. But if you work towards building a broad portfolio over a number of years and investing across a number of different geographies, so Europe, the US, the UK, that's going to really limit the risk you're exposed to. So statistically, I think it is at around a portfolio of about 50 investments, your risk of losing money is lower than 5%. I think it's around 2.5%. But what's amazing about venture is kind of the returns are asymmetric. And what that means is basically that there's kind of no limit to the upside in a particular investment. So what you're trying to do is you're trying to get into that one company that goes absolutely bananas and becomes a generational company. So you can think of that one company is going to offset all the losses for all the other companies you get into. So in this, you just want to have as many shots on goal as possible. At least 30 to 50 investments is probably the minimum. And then once you have that in place, your risk is, really protected. So I think it's really important in this asset class more than any other that diversification is really important. And we've geared the entire platform around that with our quarterly drops, investing in multiple opportunities at once, and then doing that over a period of years. So you have a really broad portfolio, and that's going to give you the best chances of making a good return.
Yeah, I think that was the biggest thing I had to get my head around, was understanding that if you were to make, for example, 10 investments, that the goal of these businesses you're investing in isn't to double their investors' money or triple it. It's to go 20, 30, 40x. And it's perfectly okay for 5, 6 of them to fail. Maybe 2 of them could go okay and, get a a reasonable return, but it is very much on the one or two that can go all the way and give you that 40, 50, 100x ROI. And as you touched on there, it's having that diversified portfolio. The more rods you have in the sea, the better chance of catching that big fish. So, look, sorry, Scott, go on.
No, I was just going to say it's a phenomenon known in venture as the power law. It's also known as the Pareto principle, and you see it in lots of other things as well. Like look at the S&P 500. You know, only the top 7 of those companies in the S&P 500 are responsible for more than 30% of the overall returns of that entire ETF. So we see the phenomenon everywhere. It just goes to show how important diversification is.
Yeah, and remind me, how long have you guys launched?
We just launched in December 2024, so we're 5 months in, but have been working on this for quite some time. Myself and Scott came together on this in 2022. We spent the first year kind of probably building the wrong thing. You know, the goal was always to build a solution that allowed people to invest in startups. But being kind of naive, green, first-time founders, we probably listened to too many opinions and too much advice. Hadn't fine-tuned our filter when it came to listening to people, and probably ended up just going off track on it. So we, at the end of 2022, we thankfully, even though we had started generating some revenues on our original kind of version 1 product, we scrapped it and said, right, we need to refocus here. And that brought us down the track of regulation with the central bank. We're authorized to operate across, to support investors across Europe. And that was a nearly 2-year journey in and of itself just to get authorized by the CBI. So that meant that we couldn't operate during that period. That was very much, application phase and also building, like alongside that, we were building out the technology as we were applying for the license. So it took full 12 months of application phase, many back and forths, many setbacks and roadblocks along the way that kind of slowed things down, and got our application in at the end of 2023, and then another 8 months back and forth to CBI before actually getting licensed. We got licensed last August 2024, went through a bit of a rebrand in preparation for launch, and then launched in December.
Yeah, it's fascinating. Similar to the journey I've been on with data ships, the initial product we launched, we thought that would see us through all the way. Very quickly, our customers led us, down a different path on what they wanted, and ultimately we set about building that. But I suppose what's gone right since the launch?
Scott, do you want to take it away?
Yeah, I can jump in. What's gone right? I mean, a lot's gone right. The first launch was really successful. We brought on 100 customers for the first launch, and we invested into 2 companies. And I think what was really exciting about that first launch is just how quickly we filled the allocation for those companies. Like we thought it was going to happen like over a week or 2, and then it ended up all coming together within 3 days. So there was a huge appetite, and that was really exciting for us. And just to see the platform working after, a couple of years of building, and then finally you get customers using the platform. All the payment flows worked to a degree. There was definitely a few hiccups along the way. But to be expected. I think all in all, for our first launch, it went really, really well, and that just kind of, gave us more hunger to go on and do it again. And it's been the same in any subsequent launches. Like all the allocations been filled up really quickly. People are really excited about the deals, and just being able to talk to customers who are using the platform is really exciting, because, like I said, we went through that kind of process where it was very isolated, going through the central bank regulatory authorization. So to be able to talk to customers and figure out like what's working for them, what's not working, is just really fulfilling. So yeah, just really looking forward to pressing on and keep building for our customers and what they want. Yeah,
I think there's you could sit here and talk about all the things that go wrong or don't go as you wish they'd go, because that's just the nature of the beast, right? But I think what's nice is as Scott said, like speaking to real customers that are on your platform, using your platform, and listening to their feedback and them saying, can I do this? And then maybe it's not something we can do right away, but we're like, actually, that's a good idea. Let's go and do that, and like ship that change and ship that feature for them. That's been nice to like the iteration of the platform from launch, as we listen to the customers and as they kind of are questioning how they do certain things, or where do they find X, or how do I do Y, and us going, actually, maybe we could make that easier for them by if we put it here, or if we change that, or blah, blah, blah. So just listening to them, hearing what their feedback is on the fly, and then like shipping those changes on the go has been really nice. And I guess for the customer, like they know that, we are building for them, and they can kind of feel that by us actually responding to them in that way. But it also means like we're changing, the platform is changing in the right type of way. It's very easy to get bogged down in product and think like that feature will be so cool, and like, let's build that. And then, you release it and it's crickets. Like, no one cared. You thought it was great. No one cares. So we're just trying to do it the right way by listening to the customer first, and then, filtering and saying, okay, well, what makes sense here? So yeah, it's been nice to just hear their feedback.
Yeah, I think on that, like anything, the first draft or getting started is always the toughest point. Tweaking what you've got started, or tweaking someone else's first draft, is always the easier part. But looking forward, like where where do you see this going over the next 3 to 5 years?
Yeah, I mean, ultimately, sorry, Rob, go ahead.
Go ahead.
I think ultimately the vision for us is to become kind of the de facto private market investment platform within Europe, and really helping a broad, just all across Europe, helping retail investors get access, not just to venture capital, but to other asset classes as well that have previously been, locked behind a velvet rope. And I think there's a big opportunity in that kind of space as well. It's becoming more and more, people are becoming more and more open to the idea of having retail investors participate in private markets. So I think it's inevitable, and I think there's a big opportunity to own that distribution channel within Europe, and I think that's what we're really going to go after.
Yeah, and on that, I suppose you guys want to meaningfully scale, but how do you avoid becoming what you're kind of setting out to disrupt?
Yeah, I think it's the way that we've thought about building the technology. So about 10 years ago, like going back what I mentioned to eToro earlier, public market kind of investing platforms had their inflection point probably 10 to 15 years ago. And that's where it really started coming on. And we're at that point now for private markets, right? There's going to be we're kind of standing on the edge of this kind of generational shift in the markets. And we're going to see this explosion in private markets, not just for retail investors, but across the board. And with that's going to come access, like what we're focusing on now. What's happened to public market platforms over the course of the last kind of 10 to 15 years is, while they probably would have started with something very simple, maybe one offering, right? They ultimately grow quite bloated and quite convoluted because they add more and more and more and more on, trying to serve as many people as possible. And the problem that we find with that is that it becomes quite paralyzing when you go onto some of these applications to actually understand how to navigate them and where to start and where to go. And the reason that lots of people don't invest isn't because it's too complicated for people. It's because of friction, right? It's because it's not simple enough to actually get started. The effort, the trade-off between the effort and doing the thing just doesn't stack up for most people. So for us, the way that we look at building product is it needs to be incredibly simple and easy to use, but have that trust baked into it that people feel like it's solid, I can trust it, but it's easy enough and intuitive enough that I can commit to it and get conviction very quickly and very easily. And I think it's trying to maintain that, and that will, obviously as we grow and we add more products and, more customers and we scale, that's always the battle, right, for any customer, regardless of what industry you're in. It's like, how do you maintain the same standards over time? But I think it really does come down to that. It's like, how can we maintain that value of simplicity on the platform? Make it feel like a world-class consumer fintech application, like people have people are spoiled with Apple level UX, right? So how do you maintain that while also making sure that the application is so simple to use and intuitive that people don't feel like it's an effort, that it's just simple and they can come on and they can just have conviction and commit to things very, very easily. I think it's maintaining that is how we win that.
Yeah, and kind of tied in with that point, I think the venture capitalist landscape has changed significantly even over the last 12 months with the introduction of AI. How do you see the AI element playing out over the next 3 to 5 years?
Yeah, I think it's going to be very interesting. I mean, there's already a lot of companies introducing products that make performing due diligence on companies really easy, and even finding really great companies, kind of finding that needle in a haystack. So there's companies that are working on really exciting stuff that kind of helps investors find those great companies and then diligence those great companies. But even for ourselves, like AI can streamline so much that makes it possible for us to scale, like in terms of that due diligence, in terms of writing investment memos, in terms of speaking with customers and giving them the information they need about their portfolio, about future investments. Like AI can make this so much simpler, and we're already building tools that enable people to kind of really query their portfolio and find out about new investment opportunities through Shuttle just by sending us a WhatsApp message. So I think, yeah, AI just enables scale that wouldn't have been possible before. So yeah, really exciting few years ahead, and how we're going to develop AI on Shuttle, and just how AI is going to integrate into private markets in general. I think it's really exciting.
Yeah, I think, look, for you guys, it's a small team that you have at the moment, but do you feel that AI is allowing you to move far quicker than you would have been able to do pre-AI?
Yeah, 100%. I like, especially on the engineering side of things, with tools like Windsurf and Cursor, just the productivity levels are through the roof. So you can get 10 times the amount of work done in the same time that it would have taken you before. And I think that really enables us to exponentially grow, especially when we start hiring people. You don't want to slow down hiring. You want to hire the same amount of people and be able to grow 10 times faster than your competitor. So I think it's just really exciting time to be building in this space.
Yeah, great. No, look, it's fascinating. And I suppose focusing back on the individual and myself, like, how should I think about allocating to startup investing as part of the broader portfolio that I might have or people listening would have?
Yeah, I think, like, as I said before, venture capital isn't something that you pour all of your money into, right? It's part of a broader strategy. So typically most people's portfolios, is the bedrock of their portfolio will be made up of, index funds, for argument's sake, and maybe some individual stock picks as well. And for us, what we always harp on about is diversification, right? Diversification within an asset class and diversification within a broader portfolio across multiple asset classes. So how can you add more options to your portfolio that help balance risk, create stability during different periods that can be maybe less correlated to each other, because everything in public markets is correlated to the economy, right? So when something happens in the economy, your whole portfolio will feel it. Whether you have individual stocks across multiple different companies or different index funds, they generally will go up and down together, right? How can you introduce things that can create stability? So during a market correction, for argument's sake, something that is less correlated, that doesn't move in the same way, that can maybe create some of that kind of insulation. And so for us, venture capital is just a way to add diversification into your portfolio, give you that kind of speculative edge, and have something that's, yes, higher risk, but also potentially much higher yielding opportunities. So we look at it as, and the way we advise people who we speak to is, if you already have your stocks and individual funds or whatever it might be, how can you add a small percentage of maybe venture capital onto that? So we would say, look at maybe doing 10% of your portfolio or 20% of your portfolio, depending on your risk appetite and what your personal circumstances look like, in something like venture capital, something like startups, right? So, and what we do then in Shuttle is allow you to build out that asset class to be much more broad and diversified, right? So our approach is that indexed approach, like Scott mentioned earlier, shots on target, right? Or rods in the sea, like you mentioned, how to get cast as wide a net as possible so you might catch one of those outliers, right? So if you're trying to do that yourself, sourcing, screening, due diligencing opportunities, and then investing in yourself, like, that is a very difficult, time-consuming, costly game, right? So for us, what we're trying to do is, how do we reduce the entry point, make it accessible, and make it simple to get access, where all of that work is ultimately done by the platform, done by our team.
Yeah, no, look, it's fascinating and very much reduces that workload for people who are interested in the venture capitalist space. Just some questions from current customers and potential customers. One of them is, if Shuttle was to cease trading, what would happen with their investments?
Yeah, everything is safeguarded. So we use a nominee structure to hold of the investments outside of Shuttle's own business. All of funds are managed through our regulated payment service provider as well. So the accounts that are owned by customers on our platform that have your investable funds are completely segregated from our business. Shuttle could disappear tomorrow, and all of those investments would still be safeguarded for our investors. So they would be managed by all of the investments will be owned by and managed by the nominee. All of your capital will still be outside of Shuttle. So we actually don't touch client capital whatsoever. We keep a complete clean break between our business and the flow of funds and holding of those shares of that ownership as well. So we could cease to trade tomorrow and everything would be fine for the underlying investor.
Great. I think we've covered some of this question already, but realistically, what would the probability of making a return on my investment be? Let's go with the kind of 3 to 5 year look at this. We'll say that they've invested 5,000 a year over, we'll say 5 years, trying to diversify their portfolio.
Yeah, like Scott mentioned earlier on, like what we're trying to do is get you up to as many investments as possible. Once you get to I think as Scott mentioned earlier, I think it's around 50 investments, your chances of losing money is less than 5%. I think it might even be as close to 2%. So that's what we're targeting, right? Is how do we get you there? Now, I think a 3-year timeline is probably a little unlikely to start seeing returns. I think that's the earliest you're likely to see return, but they're fewer and farther between. I think what we say is aim for a 5 to 10 year time horizon. On anything that's that you're investing in through Shuttle, because that's much more likely when we start seeing returns in startups, whether it's an acquisition or whatnot. And certainly if it's an IPO, that's further on again. So we would say you should be aiming for the kind of 5 year plus. The likelihood of making a return, I mean, again, it kind of depends on how big your portfolio is at that stage. It's kind of hard to say exactly from where we sit now. But I think if we target, our 12 companies a year over 5, which is what we're aiming for, at least over 5 years, you're going to be significantly up in those numbers. So your chances of making a loss is less than 5%, right? So for us, we're targeting 12 companies a year, and within 5 years, you're going to be over that by 20%. So you'll be at 60 companies. So your chance of making a return statistically should be quite good.
Yeah, and I think, look, for people who are dialing in that are maybe 35 or 45 to have a 10-year view of this and think, well, I could get, a significant payday at 45 or 55, which would be, in advance of your pension kicking in. So it's probably a bit more exciting than the old pension funds as well.
Yeah, and look, we like the thing we're not, we were never kind of bar the crypto days, I guess we were never like short-term investors. We always look at things long-term. I think that's probably the right strategy to have for most people, unless you're a day trader, and I wouldn't try and be one unless you were working as one professionally. So I think everyone should be looking at these things with a long lens, not just venture capital, but your own, portfolios outside of that as well. But while you might be thinking, 10, 20, 30 years for some of your public market stuff, you want to let it sit there. There's likelihood if there's returns, it's going to be within that 5 to 10 year period, which is a typical kind of cycle for a startup. Of course, some will go on and still be managed, 10 to 20 years, but typically you're looking at a kind of 5 to 10 year timeline for the maturity of a company to go from startup to potential exit, whether that's, a merger acquisition or IPO.
Yeah. And if people's individual circumstances change and they're unable, or they decide to stop paying their annual membership fee, what would happen with their investments?
They'll still get access to them. They won't get access to new opportunities, of course, but they will still be able to track the investments in their portfolio. So we'll allow them to sign on, and it'll just be kind of like a restricted view, if you will, to see their portfolio and what they're invested in. They'll still get the updates on those companies, but they won't have access to new opportunities that are coming live.
Yeah, and we all want to try and avoid paying as much money as possible to the tax man. Are there any tax incentives with the investments like this?
There can be. The answer is kind of it depends, right? There are tax schemes, EIS in Ireland, in the UK, they have similar schemes, EIS, SEIS, where you can claim, depending on the stage of the company, almost up to 50% of your invested capital, which is obviously a pretty attractive tax break for a lot of people. It's dependent on the company that's fundraising, whether they're raising EIS capital or not. So will Shuttle be supporting that? Yes and no. It will be dependent on, it'll be on a case-by-case basis, ultimately, whether the company in question is raising under that scheme and offering that to the investors. What I would say is that the best startups may not need to even consider it, because there are some considerations and some drawbacks for the startup to raise under that scheme. If they're raising venture capital and it's a competitive round and they're able to fill that round easily, they may not decide to go down the route of raising EIS capital. But again, it will be on a case-by-case basis. But yeah, absolutely. If it is the case that one of our companies is raising that will be made known to our customers that they can take advantage of that.
Yeah, and obviously people investing in Shuttle are investing in you guys directly and backing you both to make the right decisions. What makes you guys capable of picking these right opportunities?
I think what's important about us, and what a lot of or most other platforms don't have in place, is that we only invest in deals where there's an institutional venture capitalist leading the round. So they'll be setting the terms and we'll follow in under those terms. Even in the 4 companies we've invested in so far, there's been no less than 3 different VCs in each of those rounds. So there's multiple layers of due diligence happening outside of our own due diligence. So I think that's the comfort we want to give to customers on our platform. It's not just us picking these deals. We're going in alongside and kind of riding the coattails of other really experienced VCs who've done this before, who've great track records of investing in great companies. So I think it's really important for giving trust or building that trust with our customers, that it's not just us. You're co-investing with a lot of institutional VCs here. So you can take comfort in that.
Yeah, and for people investing, like it's something that I was really interested by and didn't quite understand. So, the typical journey, or like even the journey that DataShips has been on, where we've done an angel round, a seed round, we've completed a Series A, we're hopefully going to go on and progress to a Series B. There's companies that are further down the track than us that have done a Series C, D, and E, and ones that we know that have listed publicly with an IPO. I think it'd be worthwhile explaining to people listening in, what are the exit points along that journey where you can still get a return on your investment, but the company wouldn't necessarily have to go all the way to a public IPO.
Yeah, I think there's a few exit strategies kind of in the VC asset class. The most obvious one, or most people know about, was probably the IPO. That's what everybody wants to achieve at the end of the day. But below the IPO, there's also M&A, mergers and acquisitions, which is by far the most common way startups are sold, being bought by a big incumbent or competitor. So yeah, the vast majority of exits happen that way. But then there's also secondaries, which are becoming more and more popular these days, which is basically just a company might be raising a Series C and they decide to let their staff sell 50% of their shares or whatever they would like to sell. So secondaries are becoming more common, and that can happen, within 2 or 3 years, or can happen 6 or 7 years later. So I think they're the main avenues: secondaries, mergers and acquisitions, and then ultimately the IPOs. And that can happen anywhere from a year or 2 years all the way up to 10, 12, 15 years.
Yeah, no, it's fascinating. And do you guys foresee that the platform itself, Shuttle, could be a place where people can buy other members' shares. So a business that may have gone well could be on track, but the person who owns those shares wants their own exit.
Yeah, 100%. It's definitely on our roadmap already. We want to build a secondaries marketplace, so people on our platform who've invested do have the opportunity to have access to some liquidity if they want to sell their positions. Obviously, that depends on finding a buyer to buy those shares. But yeah, we want to give our customers as many opportunities to see some liquidity as possible.
Great. And if an investment goes well, how does it work? Like, obviously Shuttle has to make money itself. What's the kind of rev share or the model that's used there?
Yeah, so we take a 10% carry, and carry basically just means a performance fee. So basically any profits you earn, we take 10% of those profits, but only after you've recouped your initial investment. So once your money's been returned from that initial investment, then we take a 10% fee. That's how the fees work with Shuttle.
Great. Well, that's all the questions I have. It's fascinating to learn more about it, and delighted to be on the journey with you guys.
Appreciate it. I mean, I guess maybe there's time for a couple of questions for you, Ian. I think you've kind of got a really unique viewpoint on this. So going from the career in rugby to startup operator to investor yourself, curious along your own journey, has there been any mistakes you've made or anything you've learned along the way that particularly was important in your journey when it comes to being an operator in a startup or being an investor in a startup? Would love to know what you've learned.
Yeah, I suppose I was in a very privileged position that, different companies would look to align with professional athletes, and you'd get sent, various different decks over the years where I'd, review them with my dad and my brother and make a decision on what ones to ultimately invest in. I think over the years, look, there's been amazing decks put across me, and the potential upside was significant. And look, I put money behind them and probably didn't dive deep enough into who are the people actually running it. And then there's been less exciting ideas, is probably what I'd say. But where I would have, a personal relationship, or I'd know the person through another person and know, that they're the kind of people who will stick it out. And when you're investing in a startup, it's not going to be linear. It's going to be stormy seas along the way. You need to have people who are going to stick it out. And the best investments that I've made are when I've invested in the people behind the idea. And they're the ones that are still going, because other people who have had, maybe a more exciting idea, but they haven't had the ability to stick it out, are the ones that have ultimately failed. And that was a big reason why I got behind Shuttle, because I was able to follow the journey that you guys were on. Obviously, I was in school with you, Scott, and a lot of people would have thrown the towel in when you're going through all the regulation. And I think you guys have the durability and the resilience to go all the way. And on top of that, I love this idea. So my main investments have been obviously data ships where I'm working. So I've one hand on the wheel there somewhat, and then the Pitch, which is the indoor golf facility in Dublin. Junk Cookies, which is a healthy snack option that's UK based. They actually, interesting, went through the EIS or EIS in the UK. And a couple of other investments, and some of which have obviously tanked, which I don't want to talk about. But yeah, that's kind of largely my advice, is back the people behind the idea, not necessarily the idea itself.
Yeah,
nice.
I think that's a really good advice. I think a lot of people come into it really analyzing the ideas and not putting enough emphasis on the people, because at this kind of early stages, it's all about the people. The ideas change. Ultimately, what you're investing in now, that idea is going to change some way. Could be big, could be small, but it's always going to change. So it's really important to really believe in the people behind the idea.
Yeah, totally.
Can I ask just one more question before we finish up, Ian? Just in terms of like Shuttle, like what drew you to it? What was your interest? Obviously, that might seem an obvious question. You've invested in some companies. You're working at a startup, so you probably have a different take than most. But what do you think people should be kind of paying attention to here with Shuttle or with venture capital, private markets?
Yeah, what drew me was the kind of the realistic view that you guys have on it. Like, had you said to me, look, Ian, if you can invest 10,000 with us this year, we'll be able to get you 100,000 back in 2028. I would have gone, look, that sounds great, guys, but it also sounds like it's too good to be true. Quite often, when it is too good to be true, it is, and it doesn't unfold the way. Whereas you guys are realistic. You're saying, look, if you, Ian, if you can have a 5, 10, 15 year view on this, do the monthly direct debits or the quarterly direct debits. This will fit in alongside your pension and the other maybe safer investments that you have, or also some of the more high risk ones you have will sit in the middle of that. And it's also a really exciting journey. Like this venture capitalist journey, you're able to follow these companies. And that is what is appealing to me, as opposed to my pension fund. I don't really have a clue where that money is. My pension manager will give me an update once a year, and it's either gone up or it's gone down. I don't really understand how or why. But this is something that I can dip into the platform and go, oh, that's going well, that's interesting, or they're pivoting because of AI. And yeah, it's being part of that journey that really appeals to me.
Awesome. Appreciate that. Okay, well, I think we're just coming up on time. We did have some technical issues, but I mean, I guess it wouldn't be a webinar if you didn't, right? Had some on our first foray into LinkedIn Live as well. So that's to be expected, I guess. But hopefully everybody made it into the webinar. I know I think we just touched on 100, bang on the mark, 100 registrants just before the event went live today, which was amazing to see so many people interested in joining us. Hopefully many of you did. Hopefully those who ran into difficulty with the live link actually managed to find the right one. I think it was posted in the original chat, so hopefully people were able to come in and see that. It's being recorded, so we'll send it on anyway, so people will get access to that. And I just want to say thanks to Ian for joining us today and for the questions, and sitting in the chair of the customer and putting those questions to us, because I think a lot of people will be interested in them. So thanks so much.
Thanks, Ian.
Brilliant. Thanks a million, guys. Very enjoyable chat, and we'll see you again soon.
Take care.